Welcome to this explainer. Today, we're cutting straight into the numbers to see if this soaring biotech stock is actually worth the hype. Let's get right into it.
So, SELLAS Life Sciences, they're a clinical stage oncology player that's been grabbing massive attention lately from event-driven investors. Now, it's crucial to remember that SELLAS isn't your traditional value or growth stock. They run on a research and development and licensing model. That means no manufacturing, no direct-to-consumer sales right now. Think of them more like a highly specialized lab, laser-focused on late-stage clinical trials, specifically for acute myeloid leukemia or AML. The game plan, if they succeed, they'll either license the drug out or build out commercial arms down the road. For us investors, this is the literal textbook definition of a binary clinical stage biotech play.
And man, driven almost entirely by clinical anticipation, this stock has just exploded. We're talking about a wild ride from roughly $1.39 over the last year, all the way up to right around $15 today. It's a classic biotech catalyst re-rating. The market is aggressively front-running upcoming clinical data, and that sheer momentum has pushed the price tag into absolute nosebleed territory, hovering dangerously close to its 52-week high.
Because of that massive run-up, the company's valuation has been catapulted to a staggering $3 billion market cap. That puts their enterprise value at roughly $2.9 billion. And honestly, it begs a very serious $3 billion question. What exactly is the market pricing in here? That is an enormous price tag for a company at this very specific pre-revenue stage of its life cycle.
Well, the entire foundation of that $3 billion valuation rests on the shoulders of one lead asset, GPS, or galinpepimut-S. This is a cancer immunotherapeutic currently grinding through the pivotal Phase 3 REGAL trial. This is it. This is the main event. Look, they do have a couple other irons in the fire, sure, but the entire primary investment thesis for SELLS hinges right here. The stakes literally couldn't be higher. A win means the company fundamentally transforms. A loss, that massive valuation is going to be in very, very serious jeopardy.
To really get why the market's so hyped, we have to look at the AML space. Acute myeloid leukemia represents a relatively small patient population, but it's an incredibly valuable oncology market with some severe unmet medical needs. The global market is actually projected to grow rapidly, jumping from $3.5 billion in 2024 to well over $6 billion by the end of the decade. That's a compound annual growth rate north of 10%. So you can see the incredibly attractive economics for any biotech firm that can successfully get a new, effective drug across the finish line.
But here is where a lot of analysts and retail speculators get it wrong. They just assume SELLAS is going to capture that entire $6 billion pie. In reality, GPS targets a much narrower, highly specific maintenance niche. The REGAL trial is only looking at AML patients who've already achieved a second complete remission. It's not some broad, one-size-fits-all chemo for everyone with AML. Because of that highly focused positioning, the realistic base case peak sales for GPS, if it actually gets approved, are sitting somewhere around $500 to $800 million. Don't get me wrong, that's still fantastic revenue potential, but it is a far cry from the multi-billion-dollar total addressable market you might hear being thrown around on message boards. Now, they do have a backup engine, a secondary asset called SLS-009, or timfisiclib. It's a selective CDK9 inhibitor, which basically means it targets specific enzymes to stop cancer cells from growing. SELLAS is doing some cool stuff here, using advanced analytics to find patients who don't respond well to standard treatments. It definitely adds some great precision medicine optionality to their pipeline. They're even testing it in earlier line AML and exploring it for pancreatic cancer. But let's be real, while SLS-009 provides some nice diversification, the company's immediate financial fate still lives and dies with the GPS trial.
So how does all this translate into a competitive advantage? Well, right now, SELLAS's economic moat is incredibly weak. We're talking a 2 out of 10. They have 0 approved products, 0 commercial manufacturing infrastructure, and no durable customer base to speak of. But if that REGAL trial succeeds and GPS gets the green light from the FDA, that moat transforms almost overnight into a highly defensible 7 out of 10. Suddenly, they'd have the clinical evidence, strict regulatory exclusivity, a wall of patents, and a massive first-mover advantage in the AML maintenance space. But we have to stay grounded in their current financial reality. Until that clinical win actually happens, this company generates absolutely 0 recurring commercial revenue. Nothing. They explicitly reported no licensing revenue in 2024, 0 in 2025, and flat 0 in the first half of 2026. When you buy shares of SELLAS today, you are buying the purely theoretical future value of their IP, not a single solitary cent of current earnings.
And meanwhile, as these clinical trials push forward and edge closer to the finish line, the cash burn is seriously accelerating. Just look at their second quarter financials. Operating losses jumped significantly year over year, climbing from $6.87 million in Q2 2025 to over $10.5 million in Q2 2026. And as they gear up for potential commercialization, scale up their manufacturing, and pay regulatory consultants, that spending is only going one direction, up. Factoring in a $30 to $40 million annual burn rate moving forward is incredibly reasonable, maybe even a bit conservative. The silver lining to that massive burn rate is that SELLAS actually has a fortress balance sheet right now. As of mid-2026, they're sitting on over $138 million in cash, with essentially zero financial debt. Their current ratio, measuring current assets against liabilities, is an unbelievable 18.8 times. So they've massively improved their liquidity. They've got a huge financial runway to see these trials through without having to panic about keeping the lights on tomorrow. But that brings us to the giant elephant in the room. How exactly does a pre-revenue company build a $138 million war chest? The answer is aggressive, heavy shareholder dilution. If you look at the numbers, at the end of 2025, they had 153.1 million shares outstanding. Fast forward just 6 months to the end of June 2026, and that number ballooned to 201.9 million shares. That's nearly a 32% explosion in the total share count in just half a year, mostly driven by warrant exercises. And honestly, the dilution risk isn't over yet. They still have millions of outstanding warrants and options, plus a $150 million at-the-market facility that lets them just sell new shares right into the open market whenever they want. So while the corporate bank account looks amazing, the underlying per-share economics for you and me have taken a serious hit. This massive wave of dilution makes the upcoming binary catalyst so much more critical. In the Phase 3 REGAL trial, everything is driven by events. The entire process kicks off the second the trial hits its 80th death event. Once that tragic but clinically necessary milestone happens, it triggers a rapid-fire sequence. Database lock, blinded data review, statistical analysis, the grand unblinding, and finally, top-line results hit the wire. That is the ultimate moment of truth that will completely rewrite this company's valuation. And it's really telling to see who is actually betting on this event. Institutions currently own roughly a third of the company. That's mutual funds, ETFs, the big institutional players. This heavy presence is a massive signal. The smart money isn't treating SELLAS like some obscure, illiquid microcap anymore. They are treating this as a major event-driven setup. You can guarantee the liquidity and the volatility are going to be absolutely off the charts in the coming months as we close in on those top-line results. So how do you even begin to value a setup like this? Traditional stuff like PE ratios are completely useless here. But when we run the math through a probability-weighted, risk-adjusted net present value framework, basically baking in all the potential paths of success and failure, the picture gets incredibly clear. The base case, which assumes positive but not mind-blowing results and a slower commercial rollout, gives us an estimated value of $11 to $16 a share. Notice how perfectly that current $15 price tag aligns with the base case. The market has priced this right down the middle, meaning there's practically zero room for error for new money stepping in today. To put it bluntly, a $3 billion enterprise value is a remarkably high hurdle. To justify paying that price right now, the market is implicitly assuming that a successful GPS trial, a seamless FDA regulatory approval, and a rapid commercial launch are basically guaranteed. It's completely waving away the dozens of future risks involved in drug development, stuff like complex manufacturing bottlenecks, getting doctors to actually adopt the drug, and the inevitable, grueling reimbursement fights with insurance companies. And that leads us straight to the extreme downside risk. Let's be crystal clear about this. GPS can absolutely fail, despite the promising science and a super confident management team. If the REGAL trial doesn't show a statistically significant and meaningful survival benefit, the entire core thesis for SELLAS gets totally wiped out. Without GPS, they're left leaning entirely on their unproven backup asset. If that happens, you could easily see the stock violently collapse back down to the $3 to $6 range. We're talking a potential 70 to 80% wipeout. Because the risk-to-reward ratio is skewed so heavily in the wrong direction right now, the analytical data strongly suggests just avoiding the stock entirely at $15. The smartest play isn't to chase this crazy momentum. Instead, wait for a much safer entry point.
Starting a small accumulation in the $10 to $12 range makes way more defensible sense, but that $8 to $10 zone is where you actually find a truly attractive risk-to-reward setup, assuming, of course, that the underlying clinical data holds up.
As the research report so perfectly puts it, quote, at $15, the investor is effectively paying today for a significant portion of tomorrow's clinical success. You're just not buying the potential for massive, unpriced upside anymore. You're paying a huge premium for a win that hasn't even happened yet, taking on all the binary risk but getting absolutely none of the corresponding discount. So the final verdict here is pretty straightforward. SELLAS Life Sciences is without a doubt a fascinating biotech company. They have real, life-changing potential in the oncology space, but as an investment at a $3 billion valuation, it's a speculative hold for anyone already in, and quite frankly, a very dangerous play for new money looking to jump in today. Which brings us to the single most critical question you have to ask yourself before trading this, or really any other event-driven biotech setup. Exactly how much of a drug's success are you willing to pay for before you've even seen the final data? Think long and hard about that as you balance your portfolio. Thanks for tuning in to this explainer, and definitely keep a close watch on those upcoming REGAL trial results.